This is Phil Cote, and welcome to this module on a trading process. In prior modules, we have covered, in general, what are commodity markets, what instruments we can trade, their pricing dynamics, and more recently, the supply-demand balances. Now, supply-demand balances are fundamental to establishing a market view in a data-driven manner. What we will focus on today is, now that we have a market view, what do we do with it and how do we go about it in terms of deciding what types of transactions we will seek to trade. So the first part, we show on the left-hand side the supply-demand balances that we did in prior module. So the blue line would represent, in this case, for oil, global oil balances, the overall supply in million barrels per day. The orange line reflects the supply, and the bottom part of the chart reflects what we are interested in which case it represents the imbalance between supply and demand, which has to be taken care of through changes in storage levels. We have shaded the area pertaining to the forecast, so anything in the white section of the chart is historical, and the forecast is in the shaded blue area. What we observe from this forecast is a certain extent a build, inventory build, meaning that the market, from a forecasting perspective, will be long, and therefore that might put pressure on inventories, i.e. inventory builds over. So what the question we are after once we have a market view through supply-demand channels is this reflected in current market pricing? So in this example, we have, as of the 6th of December, the futures curves for WTI futures, and it shows backwardation. So one question one may ask herself in this case would be, is a backwardated market structure in the current view of forward prices consistent with inventory build, are generally seen in a market either moving into a lesser backwardation or a contango market? The next step is, how do we monetize a market view once we've established it? What potential trades could we execute? And very fundamentally, how the outcomes in terms of financial P&L for each of those monetization strategies relate to our market view. So you're going to see the structure here represents more or less what we've covered in pricing dynamics. So one way to express a market call would be through flat price. So if we are constructive from supply-demand standpoint on supply-demand balances and therefore flat price, we would have risk pertaining to what we see on the left-hand side. So the left-hand side of the chart represents the historical flat price, and on the right-hand side a histogram. So the histogram is fairly important. It gives us an indication of the daily P&L risk that we have. So in this case, what it would tell us is more or less we would see P&L, daily P&L movement plus or minus $5 a barrel. So it is fairly substantial. So flat price is generally not for the kind-hearted. In a sense, it's one of the risky strategy. And the question that we need to ask ourselves in this case is, if we do have a market call, what advantaged information do we have access to in order to show a track record of performance with that call? Another option to monetize a market view would be through time spreads. So time spreads are effectively when we look at short-term supply-demand imbalances, in the case of build or draws of storage, that effectively turns into a time structure trade. Market expressing along the length of supply-demand balances through steeper contango, or the inverse through backwardation. What we can see compared to flat price prior strategy to monetize it is much less risk in this strategy, where the daily P&L movements would be represented generally within the plus minus 50 cents per barrel range. Location spreads or geographical arbitrage would represent supply-demand imbalances between locations, same commodity, same grade, and different delivery location. In this case, what we have shown is the spread prices between WTI crude at Cushing, Oklahoma, which is where the future contracts are delivered, versus the same commodity, WTI crude, in Houston. As we see, the price is higher in Houston than it is in Cushing, primarily because of the consumption center and transportation cost. Now, in this case, the risk level we see is more or less within the range of plus minus $3. Now, putting it all together is where it matters. Now, what we have done so far is shown three different ways in which we express a market call, or three different transactions types of monetization strategy. In this chart for histograms, what we show is the difference in risk level altogether. So we can see from the bottom part, the flat price is the most risky one, followed by location spread and then time spread. Now, the question that's really important for those that you need to answer yourself is a simple one, is if you choose any of those three, what extent the potential outcomes financially might be related to your market call. So in cases where you may have a view on a location or a market which might be fairly strong, you have to think about the impact of flat price movement on those spreads. So dealing with flat price is extremely risky, but also, and more importantly, arises from many factors that you cannot control or may be totally unrelated to your market call. So although it provides more risk dispersions or P&L volatility, the question isn't the size of it, is to what extent your supply-demand balances analytics is relevant to make a call in that market and the outcome related to it. The question we often get is, once we have those assessments, now this gives us unit per barrel in terms of risk level. But the question we really have to answer is, well, how many contracts we want to buy or sell? So a simple rule of thumb to position size or define your risk appetite is to work backward from what is your appetite in terms of daily gains or losses. So in this case, I've assumed $1 million. And one way to translate position size with your risk appetite is to use certain metrics. In this case, I've defined risk as being standard deviation plus minus one standard deviation. We can see that flat price results in $1.26 per barrel, allocation spread more or less 70 cents per barrel, and time spreads not as volatile, 11 cents. So if we had $1 million of risk appetite, what we can do through simple mathematics is convert this to how many contracts in terms of position size for that level of risk would be consistent with plus minus $1 as plus minus $1 million as daily P&L volatility. And you can see a fairly wide range of it, whereas flat price being the most volatile would result in lower positions, whereas the same level of risk being deployed through time spread would be a much higher position size given the lower P&L volatility. Now, finally, when in the trading process, what's very important is to come up with something fairly rigorous at your end over time, such that one, you do not equate the profit and loss outcome with decision quality. So you may have really good decisions on your process that results in a bad outcome. But when you have a bad outcome arising from bad decision quality, i.e. a little bit more gut feel type of forming market view versus data driven, that's where the problems start. So in terms of problems, one aspect we often see in the marketplace, practitioners, especially early career practitioners, is they develop the process with an absence of feedback loop. The impact of that is you never get better, you just keep repeating the same mistakes. So what we mean by feedback loop meaning having a rigorous and robust process that you follow through which you are able over time to look back and see what was the impact and outcomes of decisions that you made, and are there learnings that you can actually take on this trade that you're going to put on and become better and better over time. So that concludes this module.